Afternoon for those of you here in the room and on the telephone, and also good morning to those of you on the West Coast. We have a large crowd today. We have a good crowd here in our Venables, D.C. office, and we have several hundred people on the telephone all across the country today. My name is Jeff Tenenbaum. I'm the chair of the Nonprofit Organizations Group here at the Venable Law Firm. I'm based here in our D.C. office. We have a very interesting and very exciting program here to deliver to you today. Before we get into the details, I want to thank the co-sponsors of our program, the RAFA firm, represented by its president, Tom Raffa, there at the end of the table, and the Greater Washington Society of CPAs, which is also a co-sponsor of this event. We thank them very much. And thank you to Heather Blackley of our staff, who always does a terrific job in helping us to organize these programs. As you probably have noticed, our nonprofit group is kind of getting in the habit of doing these programs on almost a monthly basis, and we plan to continue doing so because they've been very well attended and very well received, and we've gotten some great feedback from you. In some cases, we're building off programs that we're doing elsewhere or that others in the firm are doing in other practice areas and tailoring them to nonprofits. And in other cases, we're coming up with new programs. So if you ever have any interesting ideas, issues, angles on old issues, new developments that you'd like to hear more about, always let me know, and we're happy to consider those. But we're going to try to continue to do these on a virtually monthly basis from 12 to 2 o'clock Eastern Time here in our D.C. office, always serving lunch for those of you who can make it, and then on the telephone and the webcast from 12:30 to 2 p.m. Eastern. The two upcoming ones that we have scheduled so far on July 12th, we're going to be doing a program on compensable time issues for nonprofits, the issues of kind of under the Fair Labor Standards Act, particularly for non-exempt employees. When do you have to track time? When don't you? Special issues involving conventions and meals and breaks and travel time, and a lot of very interesting and complex issues. I think you'll enjoy that program. We're going to skip August due to the number of other commitments that we have, and then in September, we're going to do a program on September 14th about telecommuting and all the different various legal issues, employment and otherwise, that arise for nonprofits in that context. So if you're on our nonprofit email list, you always get the promotions for those seminars, and we always encourage you to participate. Today's program is focused on, the title of the program is Sponsorships, Advertising, Endorsements, and Cause Marketing, Understanding Critical UBIT Issues for Nonprofits. For those of you like myself who have been in the nonprofit world for a number of years, unrelated business income tax and the various issues surrounding UBIT have been around, well, frankly, since 1950 when Congress enacted the unrelated business income tax. But it's an area of law that, frankly, hasn't changed very much, at least in the time that I've been practicing law. But it's an area that never goes away, that seems to be omnipresent, that it infiltrates so much of what your organizations do, no matter what type of nonprofit organization you are. And it's an area, frankly, that's very complex and very confusing. There also are always new developments and new wrinkles, probably most recently kind of in the world of electronic communications, that make these issues even more difficult to apply kind of in a modern-day setting. And we're going to talk about some of those here today relating to social media and whatnot. But even the basics about corporate sponsorships and royalties and advertising and endorsements and whatnot are areas that can be very confusing, and we're going to hopefully be able to sort through some of that confusion for you here today. We have three terrific speakers for you. To my immediate right is my colleague here at Venable, Matt Journey. Matt is a senior associate who's part of our nonprofit group, has been with us for several years, formerly worked at the IRS Chief Counsel's Office, focuses exclusively on nonprofit tax issues. He's a very accomplished tax advocate for literally hundreds of our clients, gets involved, of course, in the counseling side, but is also extremely experienced in handling over 100 IRS audits and appeals of tax-exempt organizations in recent years, and really speaks from a lot of experience, including IRS audits in these issues. To his right is Lisa Hicks. Lisa is another senior associate in our group, in our nonprofit group, a very valuable member of our team. Kind of like me, a generalist that focuses on lots of different areas of law affecting nonprofits, including, of course, the tax exemption issues. And Lisa does a lot of counseling to our clients, including many of you I see here in the room, on these issues on a daily basis. And finally, to her right is Tom Raffa, the president of the Raffa firm, a very well-known audit, accounting, consulting, and everything else under the sun, it seems, these days. Raffa has been a great friend. The Raffa firm and Tom personally have been a great friend of myself and our practice. We do a lot of things together with them. We share a lot of common clients, and we're always glad to do a program here with Tom. And Tom will be talking about some of the kind of non-legal aspects of these UBIT issues later today. For those of you who want to share this presentation with your colleagues, all of these presentations that we're doing now, these type from 12 to 2 Eastern on a monthly basis, are now recorded, including the last couple that we've done. And the recording and the PowerPoint are available on our website for anyone that wants to listen and view the PowerPoint. And we always send a link to that following the program. Probably tomorrow we'll send that out to all of you, so you can feel free to share that with your colleagues. And finally, the last housekeeping note, for all of you interested in the various articles, PowerPoint presentations, and other publications that we put out, many of you are aware that we keep all of those on our website, indexed by topic area. If you want to write down this link, it's very easy to find on the web, and there's resources on every topic we're going to be talking about here today, detailed articles about corporate sponsorships and endorsements and royalties and cause marketing, and probably a dozen different PowerPoint presentations. Feel free to get more detail on any of those by going to www.venable.com/nonprofits/publications, venable.com/nonprofits/publications. So with that, it's enough introduction. I'm going to turn it over to my colleague, Matt Journey, to get us started. Matt? Matt, before you get started, I neglected to say that because of the large number of people we have on the telephone, we don't have an ability to take questions through the phone. We will be taking questions from here in the room, and we'll repeat those so everyone on the phone can hear those. For those of you who are on the line, we utilize the chat feature on the webcast. If you're logged on to the webcast portion, I will get those questions. I'll try to aggregate them, queue them up, and pose those to our speakers at the appropriate times. Matt?
Before I begin, I just want to warn you that Jeff kind of oversold the presentation. He said it would be interesting and exciting. And I can assure you that I'm acutely aware, based on the amount of joy I take from working with tax law, that nothing I do is exciting. So this may be interesting, it may be informative, but don't expect exciting. Jeff lied. Our focus today is going to be on unrelated business income issues. So the first thing is to define unrelated business income. We're going to talk about some of the common sources of income that are excluded by definition from unrelated business income. And then we're going to focus on three very specific areas: sponsorship income, royalty income, licensing income, and we're going to talk then about cost-related marketing. Hopefully you guys all understand the most general rule with unrelated business income is that income received from related activities is exempt from income tax, and income received from the performance of unrelated activities is subject to income tax in most situations. Hopefully you guys have all figured out that very basic premise. And the next slide we talk about the definition, or provide the definition of unrelated business income, which is in the case of any organization subject to tax imposed by Section 511, any trade or business, the conduct of which is not substantially related to the exercise performance of such organization or its charitable or education or other mission. Basically, it provides us with three requirements for unrelated business income. First, the activity needs to be a trade or business. Second, the activity needs to be regularly carried on. And three, the activity needs to be unrelated to the organization's exempt purpose. The trade or business exception is really sort of the commerciality test. Is this an activity that taxable organizations engage in for a profit? This is based primarily on the C.F. Mueller case, a case where an organization purchased the country's largest macaroni factory and ran it as a business for the purpose of providing all of its profits to the NYU Law School. The organization claimed it was an exempt organization because all its profits were being used for the law school. But the problem was that it was engaging in competition with taxable organizations that were producing pasta for a profit. And in that situation, the exempt status of the C.F. Mueller company was a competitive advantage over the other organizations that had to pay tax. So where taxes were part of the cost of goods sold, the C.F. Mueller company didn't have that problem. So the question is, are you doing a commercial activity? Is this an activity that you're engaging in with a profit motive? Not necessarily that you're making a profit on it, but is there a profit motive? The next step is this regularly carried on? What you do is you compare this to the frequency that taxable organizations are carrying this on. It doesn't need to be something that's carried on year-round. It doesn't need to be something that's done every day. In the Veterans of Foreign War case, the court determined that a organization that was exempt and sold Christmas cards for a month a year, but happened to sell those Christmas cards around the same time as every taxable organization that sells Christmas cards sells them, Christmas, was engaged in a regularly carried on business activity, because even though the activity itself wasn't carried on all year, it was carried on when taxable entities were engaged in that activity. And the final issue is substantially related to the exempt purpose. This is the one that clients always push back on, primarily because clients will say to me when I say, this isn't related to your exempt mission, they'll say, no, we've got a very broad exempt mission, and all the funds we use are used for our exempt mission, and we need money to operate. That's not the way this works. It needs to be causally related to your exempt mission. If you are an organization that is engaged in an activity, or your exempt mission is feeding the homeless, and on the side your organization sells T-shirts that you make a profit on, the profits are used to feed the homeless, that would not be causally related to your exempt mission. An example of an activity that would be causally related to an exempt mission is if you are an organization that engages in an activity, you assist developmentally disabled adults move into the workforce by providing opportunities for them, providing jobs for them, and one of the byproducts is you make T-shirts. If you sell those T-shirts, that would not be unrelated to your exempt mission, because you have made a product in furtherance of your exempt mission, so the sale of that product would not be an unrelated business income. So just to generally recap, unrelated business income is income that's derived from a trade or business that is regularly carried on and is not substantially related to your exempt mission. There are several types of income that are almost always considered unrelated business income. Advertising income, if you have a publication and you sell ads in it, that's almost always unrelated business income. Rents from debt financed property is almost always, or is always, unrelated business income. If you control, your organization controls an S corporation, the properties derived that are passed through the S corporation will be treated as unrelated business income. And then generally, if you sell products on the open market, that would, unless it furthers your exempt mission, be unrelated business income.
And we'll get into more later on that last point that Matt mentioned. If you're selling products, and we get the question all the time, we sell products that have our organization's name and logo on it. Isn't that related to our exempt purposes? We'll talk about ways that those activities can be structured to try to keep the income tax-free. But whether the actual sale of the product or service itself meets that third prong of the UBIT test really depends on your exempt purposes and whether and how that particular product or service furthers those purposes. Sometimes it will, and sometimes it won't. In the developmentally disadvantaged worker example that Matt gave, there was an example of how manufacturing and selling products does further the exempt purposes of the organization, whereas, for instance, most trade and professional associations, just simply selling logo items that have your organization's logo on it to members and others, in and of itself is not going to substantially further your exempt purposes. In terms of questions now related, let's wait until we get through some of the basics first, just so everyone's on the same level. And then as we start to get into some of the nuances, that's probably a good time to start asking questions.
Moving on to the next slide, we look at some of the exceptions or exclusions to unrelated business income, and that's going to be really the focus of this presentation. Just as a general rule, the more passive the activity, the less likely it is to be a taxable activity. So just receiving donations will rarely be taxable. I can't think of a situation where it would be. But also, interest income from investments would generally be not taxed. Royalty income is not taxable. Certain research income or conference and trade show activities. Qualified sponsorship income. If you want to have a bingo game, that in certain circumstances will be excluded from unrelated business income. But really the focus of our presentation here will be on the royalty income and the qualified trade show exception. Moving on to Lisa.
Greetings, everyone. So the other day I was speaking to a client about the qualified sponsorship income exception, and about 30 seconds into it I could tell that I had lost him, just silence. And then I said, bowl games, and he went, oh, cool. So let's start at bowl games. In the late 80s, early 90s, the IRS started to become concerned about the relationships between corporations and athletic associations, organizations such as the NCAA, in particular with regard to two things. You will see it now, for example, that you have the GoDaddy.com Bowl, or you have the Chick-fil-A Bowl. Well, these corporate sponsors were receiving a couple things in relation to those sponsorships. The first was all kinds of benefits. Tickets to the games, hotel rooms, various VIP privileges and experiences. And the other and more significant was just a tremendous amount of name recognition and visibility. Their name and logo on the field, repeatedly stated during the broadcast, included in advertisements for the bowl game itself, on equipment, et cetera, et cetera. And so the IRS was struggling with a couple things. What do we do about all of these benefits that are being given to the sponsor, and how do we treat this sponsor recognition? This is not quite like putting a name on a building. This is a lot more, they felt at the time, like advertising. So what came about, and I have to say not very quickly, oh, thank you. In fact, more than a decade later, was the qualified sponsorship rules. And of course, the qualified sponsorship rules deal with those two things, acknowledgement and return benefits. Now, the primary gift of the qualified sponsorship rules is that it gives you very direct guidance on what a donor or sponsor acknowledgement is and where you cross the line into advertisement. But in addition to that, it gives this safe harbor, which means it gives you guidelines for when a contribution to an organization is going to be received by the tax-exempt organization without having to pay tax on it. Now, that doesn't affect deductibility. That's only the sponsorship's impact on the income of the organization. I should say it applies to cash contributions, it applies to complementary services, it applies to property. Okay, now this is where I'm going to lose some of you. Bear with me. The rule for the safe harbor is 2%. So for example, I give a $100 contribution to an organization. The question is whether I'm receiving substantial return benefits. And the IRS defines this as, am I receiving more than 2% back, something of value over $2 in my $100 example. Now, I should say that these rules apply to a broad number of programs, not in trade show and convention, not in advertisements and regular periodicals. I'll talk about that in a minute. But let's first talk about how this 2% rule plays out, and then we'll talk about what acknowledgement is and where there's exceptions to this. Okay, to make it tangible. Again, let's say that the Hicks Corporation, my last name is Hicks, I give $5,000 to the Good Deeds Foundation. So 2% is $100. In the first example, I receive a $60 return benefit. Now, what is a return benefit? Anything of value. And my recommendation very strongly is whenever you enter into a sponsorship agreement, be very clear about what the sponsor is going to get. Event tickets, free access to research, a dinner, etc. So for example, in this, because they would fall under the safe harbor, all of these benefits would come to me and the organization would receive the full $5,000 without a tax obligation, even though some of these benefits would have been taxable otherwise, right? For example, the advertising and the event program. Now, in terms of valuing, what is the value? The IRS says fair market value. So the question for all of you all is, what benefits are we giving to the sponsor, and what will we typically sell those benefits for? Or what's a reasonable market rate for those benefits if you don't typically sell them? Often clients will look at other comparisons in the marketplace. Now, if you don't fall under the safe harbor, and this is important and an area of some confusion often, if you don't, it doesn't mean that the whole contribution is taxable. It doesn't mean that. What it means is that you evaluate the value, what you would have sold these various benefits for, the value of the various benefits, and analyze whether or not, if you had just received that income, not as a part of a sponsorship agreement, but somebody had come up and said, oh, for example, I'd like to buy advertising, how would you have treated that income? That's the difference. In the first example, no tax obligation because it falls under the 2%. In the second example, perhaps a tax obligation, you have to analyze all the benefits. This is typically the way that I analyze corporate sponsorships. I go through these three elements. And again, the most important is, are you receiving acknowledgement or are you receiving advertising? The very good news is that the regulations, and I recommend that anybody who's working in this area go and read the qualified corporate sponsorship regulations. I'm going to run through quickly some of the examples that they give, but it is very helpful and very direct. But in terms of an acknowledgement, these are the elements of acknowledgement. You can, for example, on your event program, list the name and logo of the organization, a description of services or the product line. Be careful, of course, about slogans that include comparative or qualitative language. For example, if you said, we'd like to thank our sponsor, Lisa Hicks. She is an attorney practicing nonprofit law. That's a description of my product line, my services. If you said the best attorney in the industry, that becomes qualitative or comparative. You can describe, provide the contact information, basic stuff, location, telephone number, etc. A lot of organizations provide sponsor recognition on their website. You can do that. You can provide hyperlinks to the sponsor's website. I'll talk about some nuances with that, but that is something that you can do. You can even, and I get a lot of questions about this, provide product displays or samples of products. So for example, if I was the sponsor of an educational conference, you wanted to provide recognition to me, but there I was also at a table with a sample of my latest book and some of the things that I've written, that wouldn't make it advertisement. That's something that the qualified sponsorship rules allow. And interestingly, it doesn't matter whether I'm selling what I have at that kiosk or not. Or you could simply, in the example of an organization which was an automobile association, one of the sponsors provided, had their latest model Ford on the floor. Okay. Now again, when you get into advertisement is when you have things like qualitative or comparative language, price information, indication of savings or values, endorsements, I'll talk about what that means, inducements to purchase. Okay. So going back to the regulations, and again, really read these. Some examples of acknowledgement. Name and logo on functional items. I often get this question. Can we put the name and logo of the sponsor, for example, on the lanyards or on the hotel keys? Consistent with the IRS guidance, logos on things like helmets, cups, event programs, etc., anything that's necessary or incidental to the running of the program, okay. I'll talk about some exceptions, possible exceptions to that in a minute. Naming of events, this could be the Lisa Hicks, bowl, Chick-fil-A bowl, fine. Website listing, we already talked about that. A hyperlink to my website would be fine. The thing is, though, you don't want that hyperlink to go, for example, to a sales page. Let's say Harris Teeter is your sponsor. You don't want it to go to the weekly list of things that are on sale. You also don't want it to go directly to a statement by you saying, we endorse Harris Teeter, contact them today. In other words, you can't via a hyperlink get around the rules that would otherwise apply. We already talked about product displays, displays of automaker sponsored cars at the event. Okay. This is an interesting one. There's, these rules on, but you can't make statements which are qualitative or comparative. The one exception to that is if the organization has a slogan which is a regular part of its identity. And the regulations give the example of better research, better health, which really is a qualitative, comparative statement, but because it's part of their normal corporate identity, that won't interfere with the treatment of the income. The other thing that you can do is provide exclusive sponsorships to organizations, to individuals, etc. If I wanted to come to your organization and say, I will be your sponsor, but you cannot let Jeff Tenenbaum ever be your sponsor, that would be okay under the corporate sponsorship rules. There's some nuances on that, and I'll talk about in the next slide, but exclusive sponsorships are fine. Okay. So there we are in acknowledgement world. How do we start to trip up into advertisement world? Let me say a couple things first. The first is that if you have a mixed acknowledgement and advertisement, let's say in every other way the acknowledgement complies with these guidelines, but then at the very last line you have something that gets you into advertisement world, the whole thing is an advertisement. And then you have to quantify the value of it, track where you gave this advertisement, et cetera. It becomes a tremendous administrative burden. My experience is that typically sponsors are very happy with the type of acknowledgement that complies with all of these requirements, but organizations trip up because they're just simply not totally familiar with it. So for example, this is something that's not well defined, but the regulations give this example, and so I think it's worth noting. The name and logo, we talked about incidental items, but on unrelated items. So in this example, the sponsor was being named on souvenir flags. But I also think it might be important that they were only provided to pizza companies, that those souvenir flags were only being provided to the pizza company's employees. So not well defined, but I think it's something to note because they bothered to put it in the regulation. Of course, it's not like a helmet or a jersey. It was something else. A call to action, very, very important. The regulations provide two examples of this. The first was a sponsor acknowledgement which in every other way complied with the rules. And then at the very end it said, for your music needs, give our sponsor a call today. It was a call to action. The entire thing was treated as an advertisement. Why? Because it was an inducement to buy. Same thing with visit our sponsor today for the finest selection of music CDs and tapes. Comparative language.
Yeah, I see there's a question there. Just hold up to the end of this corporate sponsorship section, and then I have a number of questions from the webinar too.
That's going to depend on the context. But I think that this quote gives you an example. A comparison to others in the industry is what you need to be focusing on in many circumstances. An endorsement. The regulations give this example. We endorse sponsors' drug and suggest you contact. Now there, of course, you have a call to action, inducement to buy, but you also have a statement of endorsement, which the IRS is regarding as a qualitative statement. That's an area to be careful of. And I already talked about web links to sales pages. Now, quickly, the safe harbor. So again, that's the ability to treat the income as not taxed, right? Doesn't apply in a few circumstances. One is if you're receiving payments that are contingent payments. Contingent means that it's contingent, for example, on we will give you $30,000 if 1,000 people come to your conference. We'll give you $40,000 if 1,500 come, because it's tied to levels of attendance that doesn't qualify for qualified sponsorship treatment. The same if they said we will give you $30,000 if we get X number of hits coming through the link on your website. So be careful about those elements. Exclusive provider arrangement in comparison to exclusive sponsor. Now I said again, I can be the exclusive sponsor, but if you also agree that I am the only person who can sell soda at your particular event and it effectively blocks out other competitors, then that doesn't qualify for qualified sponsorship treatment. That's a kind of a rare circumstance. But it's one of the things that the IRS mentioned, because what they were seeing was that, again, in this bowl game context, athletic associations were giving exclusive provider arrangement for concessions. Convention and trade show. I see this a lot. If your sponsors are getting back things like exhibit booths, tickets to the trade show, acknowledgement at the trade show, that shouldn't be analyzed and shouldn't be presented as qualified sponsorship payments necessarily. What you should treat it as internally is under the convention and trade show exception. Now, of course, it's not going to be taxable likely because of that other exception, but it doesn't fall under the qualified sponsorship rules per se. And the last one is acknowledgement and a regular periodical. Now, typically this will be your journal, but it could also be anything that's regularly published by you, your e-newsletter. It includes things that are online, so your online versions. What's important is a couple of things. If you have, for example, a special periodical, it's not regularly produced, but it's one that you only come out with in conjunction with a particular event, and you want to provide sponsor acknowledgement in that particular journal, which comes out only in conjunction with the sponsored event, you can do that. That will be covered by the qualified sponsorship rules. The other question I get is, okay, let's say it is going to be in a regular periodical. Is it necessarily advertising? No. I would look at this PLR. It's an interesting issue. Often, if you're not in a zone where qualified sponsorship directly applies, I would still comply with the acknowledgement rules. Because here the IRS said, okay, you were doing this in a regular periodical, but because you were doing it consistent with the qualified sponsorship rules, in other words, you were only acknowledging a sponsor, you weren't providing advertisement, they called it public interest advertising, not subject to taxation. A last item, in terms of valuation, we're evaluating what's the value. A couple of things. What you look at is the tax year. Tom can speak more clearly on that. But it's important, for example, in pay up front. Let's say an organization has a 3-year agreement. They pay $75,000 in the first agreement, pay nothing in the next 2. Because it's a tax year analysis, you're going to have no safe harbor in years 2 and 3. So think about that, because you look at what is the value and what's the return benefit every year. The valuation date. There will be a deference to the value that's stated in contracts. And again, if you remember nothing else about qualified sponsorship, remember when you enter into these arrangements, really evaluate and document the benefits that are getting given back. If you specify, for example, we are giving advertising and that advertising will be worth $1,000 because that's what it's worth in the year that you entered into the agreement, there will be deference to that. If you do not, then if the IRS comes and audits it, they will value that advertising at the going rate when the advertising is provided. So let's say you entered into a 5-year agreement. You valued it for each year at $1,000 because that's what it was worth in year 1. Instead of looking at that, they will look at what it was valued at year 5. A few essentials. I have already talked about these, so I don't think we need to look at them a lot. Always specify the exact form of acknowledgement. I think it helps set sponsor expectations, and it sets parameters for your staff on what's the appropriate form of acknowledgement. Specify, I already talked about this, all return benefits. If you are giving taxable benefits back outside of the safe harbor, value those, so that you know what portion of the sponsorship payment you need to pay tax on. Have the right to approve any copy. Repeatedly in the regulations, they talked about situations in which a sponsor was making statements which were not consistent with the qualified sponsorship rules. What you really want is the ability to review all copies so you don't end up in that situation. And the last is specify the site to which hyperlinks will be provided. And I already talked about the reason for that in the Harris-Teeter example.
Lisa, before we go on to royalties, we have I've probably got about a dozen questions related to corporate sponsorships from the folks on the webinar, and I know we have some in the room. So why don't we take a few questions? We can't get too bogged down here, but before we move on to the next area, this gentleman here had a question.
You're the official lawyer of the Chick-fil-A law. Is that an endorsement
think
it's very commonly used.
Yeah, I mean, I think that'd be just the exclusive sponsor.
Yeah.
I don't think, it doesn't mean that, if they prevented, folks in connection with that ball from utilizing other lawyers, that might be a different story, for legal services, but just being the exclusive sponsor should be fine.
Official is an exclusive designation. It's not the best, so I think, yeah.
All right. A few other, let's kind of try to go through these very quickly. One basic question that probably most of you know the answer to, just because I have a test of what you just heard, is an acknowledgement unrelated business income. And just to reiterate, kind of what the corporate sponsorship rules are all about is codifying in statute this principle that if you merely acknowledge a sponsor as opposed to advertising a sponsor's services, then the money you get from that acknowledgement is going to be treated as a contribution, which is tax-free income, and it gets booked, as a contribution, corporate sponsorship on your books and tax returns and whatnot. Whereas if you are cross that line into advertising the sponsor services, then some or all of that money may be treated as taxable unrelated business income. There was a question regarding is there a difference between what type of publication the advertisement is in, whether it's a monthly magazine or a conference brochure? Does this change the analysis? And this is a bit of a complicated area of law. There's this qualified convention and trade show exception that Lisa mentioned, which has been around since 1976, broad exception that exempts most revenue that trade and professional associations receive, for the most part, in connection with their qualified convention and trade show activity. The conventions and trade shows have to meet certain requirements, but it's a very broad exception, and it was frankly designed to help ensure that it was something that ASCE actually lobbied for back in the day successfully, and it helped ensure that trade show income was not treated like unrelated business income equivalent to advertising. But there have been some kind of unique twists in that when it comes to advertising in conference and trade show brochures. As Lisa alluded to earlier, there's a couple rulings that suggest that if you are not advertising your conference, if you're not kind of going out and soliciting ads for your conference and trade show brochure all year long, it's just kind of a once-a-year deal, that if you receive advertising in that, it may not be treated as unrelated business income. The converse, though, if you offer, like many associations and other nonprofits do, you have your whole package of advertising and sponsorships that you offer to your corporations that you do business with, your partners, your vendors, your suppliers. And you typically offer a whole menu of everything that they can do with you and for you. And it includes your advertising in your monthly magazine, and it includes a booth at your trade show, and it includes advertising in your conference brochures and things like that. In that situation, the advertising is going to be deemed one unified advertising program throughout the year, and all of that advertising income, even the stuff that you get from your conference, is going to have to be treated as unrelated business income. Another quick question here. What if you, this really gets into the next area, so why don't I hold it for that. In terms of the 2% safe harbor, Lisa, if you're getting some sponsorship money, but you decide to defer some of the revenue and some of the benefits of the sponsor to the following tax year, would that enable you to, if that would fit within the 2% safe harbor, is that something that you could take advantage of?
Well, I don't know on how you defer, but the basic concept is that you look at what is received and what is the value of the benefit returned in each tax year. So that would be an example in which, in contrast to the $75,000 upfront payment in year one, you now have payments and return benefits which are analyzed in each tax year.
Yeah. Another question, how do you value something given to the sponsor that doesn't have a readily identifiable value, something that's not easy to go out and price on the open market? How do you put a value on that? I know we deal with this all the time.
We do. For example, a sponsor has the right to participate on the following committees or to go to board meetings. I see a lot of these things. How I treat it, if it's something like that, is treat it as an opportunity for the sponsor to promote and participate within your organization, and treat it as an exempt activity. That's how to the extent that it's something else that all of your other members do in furtherance of your tax-exempt mission.
We had a kind of question that reverted back to the beginning part, but it's worth reiterating. Someone asked, if any of those three prongs of the three-prong UBIT test that Matt discussed are triggered, does that make the activity an unrelated business activity? And the answer is no. All three prongs have to be triggered. If any one of them is not triggered, for instance, it's not a regularly carried on activity, then even if it's a trade or business that's not substantially related to your exempt purposes, if it's only a sporadic, once in a great while unique activity, it's not going to be treated as an unrelated business activity. And of course, even if all three prongs are satisfied, if you fit within any of these exceptions, then your income is not going to be treated as unrelated business income. And one more question here from the room, and then we'll move on.
You mentioned convention trade shows have certain conditions that have to be met. Does it matter whether or not you call it a convention, a trade show, a conference, a meeting, a grand party?
No, the question is, in order to qualify for the qualified convention and trade show exception, does it matter what you call, what label you put on the conference? No, it doesn't. It matters. It's too complicated to get into here, but it has to do with things like who is the audience that's attending versus who's exhibiting, what sort of educational content do you have at the conference, things like that. And we have resources on our website that Linka gave you earlier about all these issues. That convention and trade show exception, though, is very, very broad. And I did have another question here. It sounds like exhibit booth sales are not unrelated business income, and that's correct. And that's assuming, again, that the structure fits the bill because of that trade show exception. All right, last question.
Just an odd one. In our sponsorship packages, we often say, as part of their benefit, we will send a marketing message on behalf of the client because we own the email list, so we'll send it on behalf of them. Is that considered now when we're trying to do advertising for our clients?
Yeah, well, first off, it all depends on what the marketing message is. Because if your marketing message is merely an acknowledgement and thanking the sponsor for their sponsorship, no, I know you're shaking your head. That's not what that's not what you're asking about. But if it was, that would be okay. Just the same as I could stand up. I'm the president of your association. I can stand up at the front of the room and thank the sponsor for their sponsorship and acknowledge them. I can give a non-qualitative description of the products and services. I can give their contact information, their website, everything else. But if you are going to sit there and send a marketing message, we encourage you to utilize this company's products. They're the best. They're the least expensive. We got a special discount. We got a 10-year warranty. That's a marketing message. That is a substantial return benefit. You have to put a value on that. And then right. And so you have to put a value on that, and frankly, technically, you should be valuing not just the value of the ad as if they purchased it in your magazine, but the ad carries additional authority and weight because you are sending it out in your own email server to your members or whatnot. So that technically that should all be factored into the valuation. As Lisa said, it's tough to put values on this thing, but you do need to value it, and whatever that value is, you reduce the total sponsorship payment by that amount. That amount then gets carved out of the sponsorship analysis. The rest of what's there, assuming you're not providing any other substantial return benefits, would be deemed under the sponsorship exception. That part that you carved out, you then, a lot of people get this confused. They think, well, if it doesn't fit within the sponsorship exception, it must be taxable income. Not necessarily. Now, in your case, it probably is, because sending a marketing message on behalf of a for-profit company is an unrelated business activity. It fits the three prongs. But there are other instances we've seen where that does not fit the three prongs, doesn't trigger all three prongs of the UBIT analysis. So there is a chance it might still be tax-free for other reasons. All right, let's move on. Matt?
Moving on to royalties. As I mentioned before, passive royalty income is generally excluded from UBI. What is a royalty? A royalty is a payment received for the right to use intangible property rights that it does not include payment for services. The components of royalties are you have a valuable intangible property, your name, your logo, a mailing list. You have someone else purchase it, and you do no additional information, do no additional services. You just let the mark stand for itself, and they get to use it in according to your agreement. I've broken out the royalty discussion into three areas that are the primary focus in this. First is the general royalties. Second, the sale and lease of mailing lists. And third, affinity agreements, which are common agreements as well. With respect to license of name or logo, moving on. The general rule is that the less an organization does, the more likely that the income from the royalty is not going to be treated as unrelated business income. Evidence of a royalty relationship is generally a payment for a valuable right, and then the organization's activities beyond that are extremely limited. You can review the logo's usage for style, for quality. You can have the right to approve what types of activities the logo is used in accordance with. For instance, if you are an organization that is against gun control or is in favor of gun control, you can have the right to prohibit whoever you license your royalty or your logo to from using that mark in Guns and Ammo magazine or something like that. Just to protect yourself and protect the goodwill that you've established through the use of your logo. Evidence of another type of relationship that may be taxable will be if there is a personal service component to the relationship. For instance, requirement that you appear on behalf or endorse a product or a particular organization. That was in Revenue Rule 81-178. In that situation, it was a professional sports organization where the organization leased its logo, but in addition to that, where the athletes would go out and endorse a product that was above and beyond a mere royalty, so the income was unrelated business income. Significant activities provided by the organization, such as right to approve editorial content or write articles for a journal that someone else is publishing, that is also going to be above and beyond a royalty. Those were the Fraternal Order of Police of Illinois and the Fraternal Order of Police of Massachusetts cases, where the court said that you were doing more than just allowing the publisher to use your mark. You were doing everything about the publication. You were the one that was writing the articles. You were the editor of the magazine. They just used your mark and used your articles and assembled it for you. So that was considered unrelated business income. And then, of course, the existence of a quid pro quo portion of the transaction is also going to be considered above and beyond a mere royalty. The IRS has taken a very strict position with royalty income. So if you have an agreement where you license your mark or name to another organization and there is a dual component, a service component also attached to that, if the service component is minimal, you're likely not to have an issue. However, the service component is significant based on our experience with the IRS. The IRS is likely to treat the entire agreement and all the revenue derived from the agreement as unrelated business income, and none of that will be apportioned to royalty income. Courts have disagreed with the IRS, but still the position we see that IRS agents taking on examination is an all-or-nothing position. When entering into a dual-use agreement, a couple of the things that based on our experience, we recommend. The IRS prefers to see two agreements, where you have a royalty agreement and a service agreement. They're separate from each other. That way it's easy for the IRS to determine which is which. That's not necessary. We've had several wins where the IRS has come in and said this is a dual-use agreement. It's all unrelated business income. We've convinced the agent that no, in fact, it can be apportioned between the two types of activities. The only issue with that is unless when the IRS comes in and says it's all royalty income or all unrelated business income, it becomes expensive for us to come in and explain to the IRS that they're wrong. If you're not going to have two agreements, in the agreement itself, you should clearly bifurcate the royalty service payment and the royalty and the service payments. So that way, you don't have two agreements, but 13% of this is for the services we provide. 87% is for the royalty because our mark is that valuable. As long as that is a reasonable, which is the next one, amount, and you provide evidence and support for the position taken, the IRS is likely not going to challenge that because when you're dealing with the IRS, you're dealing with an individual in the bureaucracy, and a reasonable hurdle is a hurdle that is not likely to be traversed during an examination. If you present a reasonable allocation, the agent is not going to go back and try to pick a fight with that for most cases, unless the agent has some other motive for doing that. And finally, the last thing, and this is the most important, is don't call the agreement a service agreement. It may seem like this is not necessary to mention, but so often we see royalty agreements where the organization itself says this is on the top. It says service agreement between organization and taxable entity X. In those situations, the agent's not going to read the agreement itself. The agent's going to see a service agreement and say this is unrelated business income and stop there. And once again, we'll win those situations and we'll be successful. The problem is it's a lot easier for you to delete service at the top of that agreement before you enter into it than it is for you to pay us $5, $10, $15, $20,000 to come in and explain to the IRS that there's more to an agreement than the title of it. Moving on to mailing lists. Mailing lists, generally, if an exempt organization leases its mailing list to another exempt organization, it is excluded from unrelated business income under 513H. The issue you see more often is that an organization leasing it to a taxable entity. The lease of a mailing list to a taxable entity is generally excluded as a royalty, but courts have looked to whether or not there are significant activities involved with the lease of the mailing list. This was done in the Common Cause and Planned Parenthood cases where they focused on this. Some of the specific activities that they look to is whether or not the organization is tailoring the mailing list to the needs of a particular industry in terms of how it's sorted or how it's organized, and whether or not it's marketing its mailing list to specific taxable entities. For instance, if you are an animal rights organization and you've got a mailing list of lots of individuals who are donors and sympathetic to your cause, and a organization that sells vegan products comes to you and says, we're a taxable organization, if you start organizing your mailing list and start reaching out to specific entities in the taxable community that can use your list for their profits, that may be considered going above and beyond just obtaining a royalty. Similar to the best practices I had with the general royalties with the mailing list, it's the same thing. IRS prefers two separate agreements for a service and for a royalty component. That's not necessary, but make sure that you do bifurcate clearly in the agreement what services are provided and allocate a portion of the revenue to those services. Second, once again, be reasonable about this. Don't do 90-10 split, 95-5 split on all of your agreements. Every agreement is different. Every time you enter an agreement, it is a different relationship. Look at the relationship and determine what is the true allocation here. If you do this step in the beginning, much likely to have problems with the IRS in the future. And finally, once again, don't say it's a service agreement. Repeat myself, it's never good when the IRS comes out and says, well, this is a service agreement, it says so. We win those, but it's expensive. Finally, the affinity cards, and I use affinity card because that's the one that the courts have most commonly ruled on. With the Mississippi State University Alumni Association, the Oregon State Alumni Association, and the University of Oregon Alumni Association. There seems to be a trend here with alumni associations. But this is also true of agreements with rental car companies, the insurance agreements as well. But courts have ruled that payments received by organizations through affinity agreements are generally for valuable rights, the logo, the mark. The IRS has taken the position that it was the sale of a mailing list that's not exempt from unrelated business income, but the IRS has lost every time. The issue is really whether or not there are significant services being provided in addition to this. Whether or not when you provide the mailing list, you are also providing an endorsement of the products being mailed. Are you also providing sort of a management service in addition to you're presenting the mailing list in a way that benefits the bank or other organization as part of the affinity agreement? Or are you just providing them what you have on your records? Do you have a file? Do you just forward that file to them? That's really what the courts have looked at.
Okay, Matt, before we go on to the next topic, I'm going to real quickly plow through a few of the questions we've gotten from the webinar component because I think it touched on a few important issues that we haven't drilled down into. And I apologize for the speed at which we're going to have to kind of cut through the rest of the material today, but we want to make sure we have plenty of time for Tom's presentation. First off, is the selling of a rental of a mailing list of past conference attendees or trade show exhibitors considered royalty income? I think the answer is going to be it's going to be treated the same as your membership list. It's the same exact issues and analysis that Matt just talked through. Does that exception for running your mailing list from a C3 to other C3s apply if you're running from a C3 to a C4 or to a PAC? And I think the answer to that would clearly be no. That special exception doesn't apply. Of course, the same basic analysis that we just went through would apply. If you sell ads in a silent auction, this is kind of a general question about you, but if you sell ads in a silent auction brochure that's only conducted once a year, Is this going to be considered regularly carried on? The best, I think, answer to that can be found in the NCAA versus, what was the plaintiff's name? The commissioner. It was the famous IRS case involving the NCAA the Final Four tournament, where the issue was whether advertising revenue from the program brochure that was only kind of utilized during the Final Four tournament in a short time leading up to it, whether that was considered a regularly carried on activity, even though the ads were marketed and sold for several other months during the year. There, the court ruled no, it was not a regularly carried on activity. Here in this example, even more so, it probably isn't even less of a regularly carried on activity. The second part of the question is an interesting twist too. It said the items sold at the silent auction are created by students of the school that's putting on the silent auction. There, I think you have an argument, obviously we need more facts to know it, that it may even be a related activity because it's furthering the exempt purposes of the school, in which case you never even get to the issue of whether it's, you have two different prongs. So it either doesn't meet the regularly carried on prong or it doesn't meet the substantially related prong.
That's actually really similar to several rulings that the IRS has published with respect to student newspapers. At schools where they have a student newspaper, part of the education of the students is allowing them to run the newspaper in every aspect of the newspaper, including the sales of advertisements for the paper itself. In that situation where the students were actually selling advertising in the paper, even though that would be generally an unrelated business activity, because selling advertising for a paper is part of running a paper and educating students about running a paper was part of the organization's exempt mission, the IRS determined that the sale of those advertisements was related to the organization's exempt mission, which would be similar to the situation here with the silent auction.
Three other kind of common issues that we get all the time. What if the company that your nonprofit endorses is offering a discount to the members or supporters or constituents of the nonprofit, but the company is not paying a percentage of the sales to the nonprofit in the form of a royalty? In that situation, if they're merely offering a discount but not paying any revenue, we never get to these issues because there's no income to determine whether it's unrelated business income, and that would be perfectly appropriate, and it's not going to trigger any UBIT issues. Another common issue, if a wholly owned for-profit subsidiary of a nonprofit, very common structure in the association and nonprofit community, if that for-profit sub produces a product or service, the nonprofit is endorsing that product or service to the association's members, and then it's getting a royalty as a percentage of sales in exchange for that endorsement. Is that going to be taxable? Well, here there's a very special rule under Section 512B13. See, I can quote tax code sections too, like you. There's a special section of the tax code that says, while typically if you were simply licensing your name and logo and mailing list to a for-profit company and getting paid a percentage of sales in exchange, that's what Matt just described. It's a tax-free royalty as long as you're not providing any marketing services or administrative services. But when that for-profit company happens to be a majority owned, or is it 80%, I think it's 80% or more owned subsidiary of the nonprofit organization, then there's a special rule under the Section 512B13 that comes in and says, in that situation, to the extent that the royalty payment by the sub provides a tax deduction for the sub, to that extent, the income to the parent nonprofit is treated as unrelated business income. There is a special exception to that rule that was enacted by Congress in, we think, around 2006. I can't remember the exact year. It might have been 2007. That said for contracts entered into at that time, as of that date, that as long as the payments were at or below fair market value, that would not be treated as taxable income. That exception has been extended every 2 years by Congress, but it only applies to contracts that were in place at the time. The last common issue, and I know we've dealt with some of you here and on the telephone in this issue, if your association or your nonprofit runs a magazine, you outsource that magazine to a for-profit publisher to do all of the editorial and also the advertising, sales, and marketing and whatnot. Many nonprofits will treat the money that they get from that for-profit publisher as a royalty, thinking they're simply outsourcing this arrangement. The publisher's doing all the work. We exercise some editorial control. Of course, we provide some content, editorial guidance, but it's really the for-profit publisher that's doing all the work, so we're just going to get a royalty, as either a percentage of everything the publisher earns or calculated in some other way, and we're going to treat it all as tax-free. Well, as some tax court decisions involving state police associations, I think primarily.
The police cases I mentioned.
Yeah, those police cases that Matt mentioned earlier. What they make clear is that in this situation, unless you have a completely hands-off approach, and I've yet to see many nonprofits that have a completely hands-off approach over their primary publications, then that publisher is going to be deemed an agent of your nonprofit organization. And so with a principal-agent relationship, the character of the income passes through from the agent to the principal. So if the agent is earning primarily advertising income, which is usually how these deals are structured, then the character of that advertising income passes through to the nonprofit organization, and that has to be treated as taxable unrelated business income. Yeah, one question here.
So, I guess I don't understand. Is UBIT bad? I mean,
yeah, you know, it's a very the question for those of you on the phone, which is a very fundamental one, and I apologize, we did not address this up front, although I think we're going to talk about it later, is UBIT bad? And I think the short answer is no. In and of itself, UBIT is not bad. Earning more money for your nonprofit, which is generally all going to help subsidize and further your exempt purposes, is not a bad thing at all. I have always, since the first year I've been practicing law, been advising clients to not let the tax laws be the tail that wags the dog of your nonprofit. If you can go out there and generate additional revenue to further your exempt purposes, or offer discounted products and services to your members, or provide new products or services that don't otherwise exist on the market that help your members or supporters further their own businesses or professions or industries, that's a good thing. It's a very good thing. And there's nothing wrong with paying some tax. And just like any for-profit company, you're allowed to take deductions for directly connected expenses. So you may be earning income, but you may not even have a lot of tax. You know, if you're smart about how you do, and Tom will talk about, you know, these issues about deductions and when you can take them, because that's a huge issue involving how much tax you actually have to pay. But there is this overall rule that we should have stressed, and that is that you cannot earn too much unrelated business income without jeopardizing your exempt status. If you earn too much, more than what the IRS calls insubstantial, then you jeopardize your entire exempt status. There is no bright line test as to where that is. We generally caution our clients that if your gross unrelated business income starts to approximate about 20% of your total income, then that's getting you into a danger zone where we generally recommend the creation of a for-profit subsidiary to shift one or more of those unrelated business activities into that for-profit sub, where you can then conduct them without limitation. But you do want to be cognizant, and it's all unrelated business activities combined. A lot of people don't realize that. It's all of them combined. So keep that in mind. Last topic that Matt's going to talk just really for a few minutes on, cause-related marketing, and then we're going to turn it over to Tom.
Yeah, for the cause-related marketing, I've got about 15 or 16 slides here. The slides go fairly in-depth in their discussion and in the information they provide. If I were to give an in-depth discussion covering all the issues with respect to cause-related marketing, I would be standing up for 8, 10, 12 hours, probably longer. And none of you want that, I can assure you. I wouldn't mind it. I'm a lawyer, so I really like to hear myself talk. But other people don't like that so much. So what I did was I tried to provide more information and more specific and detailed information in the slides that I'm actually going to cover here, just so that the high points are hit on for you, so that you can sort of take this home with you, and you think you have a cause-related marketing issue, you can pull it out and say, okay, well, that's one of the states mentioned, because you don't want to hear me talk about all the various state statutes that there are. But moving on, just generally speaking, cause-related marketing or commercial co-ventures are situations where a commercial entity uses your name or logo in their advertisements with a promise to pay a portion of the proceeds from the sales of their product to your organization. The organization, the exempt organization in this role, is completely passive and has almost no control over the situation. That's all good, and that's one of the reasons that this isn't unrelated business income, is because you're not involved at all. Like, you just cash checks, which is a great thing for an exempt organization to be able to do. The rewards of this are increased donations and increased awareness of your organization, because not only do the advertisements help the advertiser, but if Nike comes to your organization and say, we like what your organization does and we want to give a contribution to your organization and use your organization in our advertisements, Nike advertises a lot. So it's going to be great for your organization, because a lot of people are going to be hearing about your organization and how great your organization is. Some of the risks are that you don't have control over the advertisements or where they're displayed. And the where they're displayed part is one of the bigger risks here, because Nike advertises in a lot of states, all of them. And so your organization may currently only be registered in D.C., Virginia, Wyoming, or wherever. All of a sudden, your organization is going to need to register in states throughout the country, states where you previously had no activities and you have no understanding or no familiarity with the law. So there are issues with respect to that. Another issue is you're relying on the taxable entity's reputation in advertising your product. If Nike says for every time you buy X shoe, we're going to give $1 to this charity, if those shoes start blowing up for some reason, that's going to be associated with your charity. So please don't associate your charity's name with shoes that may blow up. Commercial co-ventures.
It's a realistic example, right?
I'm on the fly here. I'm not very creative. I'm a tax guy. Commercial co-ventures slide covers much of the same ground as the last slide, so for the sake of time, I'm going to skip it. Currently, more than 40 states regulate the various methods of fundraising in their state. In those 40 states, you may be required to register as an organization that solicits funds in their states, even if the only connection you have to that state is that your logo appears in an advertisement in a magazine that gets shipped to that state that you have no control over. There are about 20 states that have specific laws with commercial co-ventures. The purpose of laws is really to protect the consumers, because the consumers are the ones that are purchasing certain products or making certain decisions based on the promises of the taxable entity that's advertising. So this is really within the respect to the attorney generals of the states trying to protect their own citizens. Jeff told me to wrap up, so I'm not going to actually talk about the statutory language of various commercial co-venture statutes. I'm just going to skip to the end where some of the more general advice with respect to what you should do when you enter into commercial co-venture or cause marketing, and that's on slide 42. First of all, it's important to identify when you are in a commercial co-venture, when you may have additional registration or filing requirements. You need to know that so you can act appropriately. If possible, plan this in advance. When you are looking at entering into potential cause marketing program, make sure that you understand the taxable entity you're going to be working with. Make sure you understand your filing responsibilities, where the advertisements are going to be made, and make sure that, and just so that you know that that you are comfortable with your mark being associated with a certain product. Make sure you know the product that it's being attached to. Always have a written contract. The states that have statutes that govern commercial co-ventures require written contracts. They need to be signed by an officer. At least in one state, Massachusetts, it needs to be signed by 2 officers. Several states require you to actually file a copy of the contract with the state when entering into commercial co-venture activity so that the state can monitor the activity. And then finally, monitor the co-venturer for their compliance. This is a very small issue for them, and generally they're not going to be as focused or as worried about the proper compliance with their co-venture requirements as your organization. If Nike has a complaint filed by the Attorney General for violating the co-venture statutes, that's a minimal expense for them. But if your organization, a C3 organization that in large part depends on the goodwill that your organization has created and the public perception of your organization, gets in trouble with the state AG's office, then that's going to harm your organization far more than the other entity, even if it's their fault that you're sort of getting the bad press. So always make sure that you monitor the taxable entity involved as well.
All right, let's take one question here in the room and one from the phone, and we'll move on to Tom.
To follow up to the question and answer, is UBIT bad? Within the last week, I saw a notice that the IRS had taken away the exempt status of 200 organizations. The implication was because they hadn't been filing a Form 990. The question I have is, did they do any of those exempt status pulls based upon this UBIT issue, or is there any effort that you know at IRS to look into this as a source of revenue for themselves?
The question has to do with the recent announcement within the last week that thousands of exempt organizations had their exempt status revoked for failure to file the Form 990, or specifically the Form 990N, and whether that has anything to do with unrelated business income. No, it does not. That has to do with a change in the law that Congress made a few years ago that said if you're recognized by the IRS as a tax-exempt organization, you have to file some form of a Form 990, the most basic for the smallest, even no-income organizations being a Form 990N. It used to be that if you had less than a certain amount of income a year, you didn't have any filing obligation. Congress said that's not good. We want to be able to track who's out there, who's an exempt organization, who's not. So they have this electronic postcard called a Form 990N that even the smallest organizations, chapters of your organization, small little nonprofits can easily file, don't need a lawyer or anything to do it. But if you fail to file 3 years in a row, you automatically lose your exempt status. And that's what happened. Thankfully, the IRS has come out with some pretty flexible, reasonable procedures for how you can get your exempt status reinstated, at least back to the revocation date. You do certain things, and actually we're finalizing an alert that we'll be sending out to our entire nonprofit list probably tomorrow on this topic if you want to forward it on. But that has nothing to do with unrelated business income. In the unrelated business income area, for instance, if you have one of those outsourced magazine situations, and it turns out that we have some clients that really have millions of dollars a year that they were treating as exempt royalty income that should be treated as taxable unrelated business income. In those situations, that's a very dangerous situation. Depending on the overall size of the organization, that could put exempt status at risk. But even in those situations, nothing happens to you unless you get audited. Because the IRS they can't just revoke you based on what's on the Form 990, even if you start reporting it as unrelated business income. It's all about what happens in an audit situation. The IRS has to come in, examine you, you hire Matt, he beats them down, and they go away. If for some reason he has never lost. If you can't convince them, then you go to an appeals process, and then Matt will beat them back in that way. But you don't get to that situation unless you get audited. But you do have another issue that we've been dealing with quite a bit. Tom, you know the current name for it, FIN 48. What's the current accounting standard name?
I don't know.
Oh.
I think it's ASC 740, I think.
Yeah, I think that's it. But yeah, 740 or 470. It's an accounting standard that essentially says, in my wearing my non-auditor hat, because I'm not an auditor, basically says that if you have an uncertain tax position, I mean, if you have some income tax, including unrelated business income tax, that there's a more likely than not certainty that you basically have treated it incorrectly. For instance, you treated it as related income, like a royalty, when it should have been treated as unrelated business income. If that's the case, and if it's material, based on your standards of materiality, then that has to be disclosed in a footnote to your audited financial statements, and you have to reserve in your reserves an amount to cover the estimated federal and state income tax and interest that you would owe on that. And to make matters worse, you now have to disclose it on the Form 990, which is a big red flag to the IRS and come and audit you. So it does have some immediate consequences, even if you don't get audited, or that could actually trigger an audit. So these really are issues that you need to pay close attention to. With that, I want to thank Matt and Lisa and turn it over to Tom for the last part of our program. Tom?
Fortunately, I'm from New York, so I can talk fast. I saw those 43 slides when they sent them over the other day, and I said, okay, now what do I talk about? There's actually a lot to talk about, and I don't know if I'm going to get through it in 15 minutes, but I'll do my best. I think the real issues that were left to me outside of all of the UBIT and everything is really more the accounting and looking at what's going on from an accounting standpoint and how these things work. Because, I also hear a lot, is UBIT bad? And no, it's in fact, we could make it look a heck of a lot better as you go through and making sure the allocations are correct. But the interesting thing is that if you look, there's more and more where there's losses reported. So it begs the question is that, okay, what's going on and why are there so many losses? And that would also lead to a lot more scrutiny from the service, which is also happening. So, if everybody's reporting these losses, there was this statistic I was looking at, an SOI, that was actually it's from 1999, but it's still relevant. There were 42,000 Form 990Ts that were filed, generating almost $500 million in taxable liability. But of the ones that were reported for C3s, the aggregated were net losses. So the whole aggregate of all of it was net losses. Now, I'm going to explain why some of that happens. In fact, certainly when you look at some of the folks now that own their own buildings, it's pretty hard to make a profit on those things. And when you're aggregating that loss with some of the other maybe possible UBIT income that you have that does net to income and taxable income. One offsets the other, so it does make a difference. The other thing, though, is that the IRS starts to think about, well, where are all these losses coming from? And they're coming from your exempt area. So it's almost like if you looked at it as an individual that owned a business and you said, well, I use my car and I use it personally, I use it business, or I go out to dinner with folks. I go out to dinner with my attorney who also happens to be my friend. Where do I move this to? And, if you're a little bit aggressive, you say, well, yes, we talk business, and you move it into your business. And that's when the IRS comes out. That's what they look at. They look at what kind of personal expenses are you taking in your business. Well, you can look at it the same way. You've got this whole exempt area here that's not subject to taxes, and the idea would be for practitioners and for management to try to be as aggressive as possible to move those costs in there to lower the amount of your tax liability. And the other area is if you think about just the start of those the way the code started up, it was really about unfair competition. And the IRS has really been focusing a lot more on that as we're dealing with them and saying, what kind of businesses are you in? Forget even for a minute that it's related or unrelated. Do you have an unfair competitive advantage for being in that business? So when I see somebody that's going to start, like one of my clients, College of Radiology, does a lot of research, and they're going to move out, they're going to start to deal with pharmas, and they're going to start a contract research organization. I say, well, there's a lot of contract research organizations that are out there that are all for-profits. There's no not-for-profits that are out there. Maybe we should just make this thing a for-profit and deal with the tax issues and not have to deal with even the unrelated portion of it, let alone if it gets big and all the rest of it. So that's also something to think about, and it really does relate to the way this started, which was New York University buying a noodle company. So it really does have some basis for it. And we're seeing that even a lot in our application process. In places where I've been doing this for 35 years, where we would apply for things like what we now call capacity builders in the sector, right? Nonprofits that serve nonprofits, right? Our firm does almost exclusively nonprofit work. That could be perceived as being an unfair advantage. It's a lot harder to get those things through applications. So you can imagine if you started to do that kind of thing, like consulting within your organization that was unfairly competing, almost better off just pushing it into that area. So despite all of the rules and the exceptions, there's a lot of logic to what's going on out there. Are you working my slides? You're a good man. I knew I had good help here. So the other thing is to look at as to why these allocation processes happen and what makes some of them reasonable. Outside of the explanation for the level of losses for UBIT is that over-allocation of cost away from exempt functions into the non-exempt functions in order to reduce liabilities. There is a lot of that. There was another study that I looked at that was around medical nonprofit organizations, and they were found to have reallocated an average of $400,000 of expenses away from their exempt purpose into the non-exempt. So into the non-exempt unrelated business income, so that they could again offset liabilities. And so some folks are much more aggressive at it. The other possibility for the over-allocation of expenses for maximizing is really like economies of scope, which is actually a little bit more reasonable when you're an accountant doing these cost allocations. What you're talking about is something like a stadium, and saying that, if I'm a university, the stadium's an exempt function in part of my athletics, and I'm going to rent that out during the summer. It's going to cost you no matter what to keep that stadium going. You can close it down, but essentially you still have to keep the lawn up and all the rest of the stuff that goes along with it. You've got your academic people in there. But if somebody goes in to use it, and you can allocate some cost to it, chances are you're not going to be making a lot of money on those allocations. And there is this whole ruling that I was going to get into about, that's on another slide, but I'll just go through it briefly, about whether it's, you allocate those kind of costs almost like you would your vacation home, right? You say, well, okay, is it 365 days a year that it's available, and therefore I rent it 20 days out of the year, so 20 over 365 of the cost would be allocated. And most of us say no. Well, if we're only using it, say, 12 times a year for football games, and then I rent it out 12 days, then it's 50-50, and I can do much more of an allocation and be aggressive about the expenses. Well, that's actually passed muster not with the service, but with court cases. The issue, though, is that the service still insists whether the court cases or not. And when we have these audits, they'll still come in and say it's total number of days that are available for you. So we have to be really careful about that. The expense allocation method used by exempt organizations, they also just vary greatly, And so what I try to tell my clients is, the most important thing is it's a reasonable allocation and to be consistent. And there are rules under 512 and 513 and all the things that were being quoted earlier that do give you guidance. But I can tell you that the reason why there's variations is because even though the laws were in 1950, there's not a lot of guidance. And generally, like our firm and me personally, I do a lot of cost allocation work. I mean, I do indirect costs for like Catholic University, American College of Radiology, very, very large organizations that are getting federal funding. There are specific rules under A122 that allow you to do all these allocations, and you can look to those and have some basis. If you're filing your 990 and you're trying to file what part's fundraising and program, there's some pretty good, especially now with the new 990. There's some specific things that you can look at and say, what do you push where, and it's pretty specific. But there's really not a lot in the code sections that relate to this other than, well, what are direct expenses and how do they relate directly to the tax-exempt purpose versus the non-exempt purpose and the piece that's unrelated business income. And that's really what I was going to get into in the next couple of minutes. It's a lot of stuff to cover in a short amount of time, but I'll just go through the technical guidance. I sort of hit that really quick, and let's go right to some of the areas of. Let's see. Just go right to direct costs, and then I can go back to something else if we have the time, because I don't want to keep everybody past this. To qualify as an allowable deduction, that is to be directly connected with the conduct of an unrelated business. The deductions must have approximate which is close to or a primary relationship with to carrying on that business. So for a business, it's what's reasonable and necessary. When I look at the code sections that relate to a for-profit business, it's reasonable and necessary. If you follow that same kind of line of thinking around direct costs and what's going to get charged directly there. And so when people come to me and say, well, I'm going to do some advertising, or I'm going to do something that's unrelated, like selling T-shirts and everything, and they get nervous about the amount of tax, outside of like a $1,000 exclusion that you automatically get when you fill out the 990 for unrelated business. So if you're making small amounts, it doesn't even matter. But if it's a consistent thing and it's going to be larger, there's actually a lot of direct costs that you can push into there. There's also what we call indirect costs, and a lot of times with the service, when they come in and look at what's being allocated on an indirect cost basis, it really has to do with your cost structure. So what we try to do as your accountants is to say, what's your basic cost structure look like, and what would be in your indirect cost or a fringe benefit pool that would be allocated to those costs. Okay, so if you have a lot of programmatic costs or you're doing any kind of federal programming, you sort of understand what I'm talking about. You have one thing where it's all your indirect costs that are not directly related to anything. So you have postage, you have your supplies, you have your accounting department, your IT guys. They're not really working on anything specific in your program. You put those in one pool and you spread those, and you spread them in order to be fair, evenly, based on some kind of denominator that's either total direct costs, total labor, so that basically it's fair. If you have a non-exempt function in there that's produced that has direct cost associated with it, so somebody's actually working that field when you're renting it out, and there's some direct charges there, and you're allocating those costs based on that cost structure, then the IRS is going to be pretty satisfied with that because they're just getting their fair share, no more, no less. Okay? And pools usually deal with fringe benefits, which everybody knows what's defined in a fringe benefit pool. Indirects may seem a little bit more obscure, but again, if you really need good guidelines on what's in indirect, you can go to OMB Circular A122, and I was going to go over some of those a little bit, but you can just show the slide really quick. But you can see there'll be, as it comes up, or at least the exploitation rules. Go to the next slide. But basically, it's like depreciation that's going to be in there, the accounting, the operation and maintenance costs, general institutional and administrative costs, those kinds of things. Okay, so that's a basic cost structure that sort of works for everything, including when you're reporting to your grantors. If you're a trade association, I had a trade association that basically would say, well, we're going to allocate everything based on estimated time. Okay, and they wouldn't do timesheets. And we used to write them up every year and say, hey, it's really up to you, but if you don't do timesheets that are contemporaneous, we're not going to be able to tell where your cost structure is. They came to us and said, we want to outsource our magazine. Tell us whether this is worth it or not. And I said, I can't. They said, well, why not? I said, well, if you're not going to allocate your time under a basic cost structure, then I'm just guessing, because you're guessing and you're allocating your time. So basically, you can take care of predominantly most of the rules as far as cost allocation goes with just that basic cost structure. What you can't really has to do with the exploitation rules, and that's something. Do we have enough time?
Yeah.
Are you good? Okay.
We can go a little bit.
Okay.
Go back.
Let me go back. Yeah. Okay, so what you're really talking about here is that most of the time when we go in to look for alternative revenue sources, we're trying to figure out what is it that would attract people to the organization that really doesn't have to be related to its trade or business. And there were a few things mentioned here, although they turn them into royalties. It's a lot of it is again the reputation of the organization and the fact that you're sort of doing that kind of business anyway. So if you look at something like the Arthritis Foundation, endorsing an over-the-counter drug, the idea behind the fact that they've got all this intangible that allows them to do that. I mean, otherwise it's not worth me endorsing that product. But the Arthritis Foundation, it carries a lot of weight. So one of our clients, Asthma, did the thing for a sharper image on a machine that cleared the air. We chose not to because of so much control, treat it as a royalty and treat it as a UBIT. But we're able to push some of those costs on those exploitation rules over to that to say, well, there's a cost that's an intangible, just like there's an intangible asset, there's an intangible cost, and those kinds of costs can get moved over there because there's really not a large incremental cost for doing that endorsement, and therefore lowering some of the net income, getting that net down so that we're paying less in taxes. Another good example that sometimes you can get moved the other way is one of my clients is Georgetown University. There's actually a student corp that competes with other businesses on campus. They sell food, they have coffee shops, and it's run by the students. And clearly, again, rather than spend a lot of time trying to push costs into there associated with it, one of the reasons why they're doing such great business is because they're part of the university, and they've got the university name and the university endorsement, even if it's indirect. We chose not to go that way. We pushed them out as a separate corporation, and we said it's all educational. And when the IRS comes in almost every 3 years and says, you have to pay tax on this, and tries to threaten our tax exemption under that, which definitely makes Georgetown nervous, but a lot less nervous than if they were hassling them about this student corp being in there. We're able to prove to the IRS that this is there for an educational purpose and it's a fulfillment and advancement of their mission. So there's a lot of ways to skin this. So when we say, why are there all these losses being reported, some of them are really have to do with how we can allocate our costs to these areas.
Tom, that raises just a good general point in the unrelated business income area, and that is that a lot of times clients come to all of us and they say, we have this activity, here's the facts, tell us, does it have to be treated as taxable income or not? And of course, sometimes it's as simple as that. We give an answer one way or another, or we say it's risky, but you can defend it. But more often than not, and what usually is the right answer is if there is some potential tax risk there, and assuming you don't want to take on that tax risk or pay the tax, is to think about ways to creatively restructure the program or activity, or even the structure of the underlying entities that are carrying out the activity to turn an otherwise unrelated activity into a related activity. That's what Tom's alluding to, and it's something that we do all the time, and you frankly should be doing. In the corporate sponsorship area, taking away certain benefits the sponsors may not care about. On the royalty side, not engaging in certain marketing services that in the end, the endorsed company may not care about. Turning an unrelated activity into a related activity by attaching literature and information about the mission of your organization can turn what would seem like a simple taxable service into something that's related to your exempt purposes. Even the selling of T-shirts and coffee mugs and things like that. If you manufacture and sell that stuff, it's generally going to be an unrelated activity unless it includes certain literature about your mission. But if you outsource that to another company to produce and market and sell, and you just license your name and logo, boom, you have tax-free royalty income. So think creatively in that regard.
Yeah, and if you can't, before you just say this is the answer, a lot of clients will say this is what I want to do, and it's like, no, just tell me where you want to get to, and we can get you there in a lot of different ways. And sponsorship is a really good example of that. I have an article I'll include it with the link for that's on sponsorship. The reason why it's so defined and it's so clear is because it was all FCC rules for the first 10 years before the IRS ever got around to writing the rules. And the FCC, it was all for public television and public radio. So when you see those sponsorships up there, it's pretty clear how they established all of that. Most of the time I just tell my clients to go back to them and say, can we pull this piece of the advertising out? And I get very, very little pushback. I mean, most people are doing it for philanthropic purposes. And if they're not, their name up there is almost as good with their address and their phone number as it is saying, we're the best accounting firm in the city for nonprofits. I mean, so, a lot of times it's a matter of pushing that. The other area with, just real quickly, on logo wear and things like that, or in giving out some quid pro quo for contributions and everything, one of the big things a lot is that, well, I'll just use it as an example, is one of our environmental groups that does a lot to save animals. They give those like stuffed animals out, and that was originally, before we came in to help them, was considered all to be UBIT. Okay, it was like a quid pro quo. They were getting stuffed animals, actually, So, but we put in program information about that animal and about that they were going to be extinct and where they lived, and so it just got around it. Next time the IRS looked at it, they were fine with it. So, there's ways to do this, and I think that's really, don't be fearful of it. Just push in. The last thing I'll just mention really quickly is on dual use. Again, that cost allocation structure is really going to help. I mean, if you're talking about that facilities again, and I'm the guy that's the operations guy, and I'm spending 10% of my time over there, if you look and you're keeping good records and you're saying, I'm doing, my time allocations just like you would be if you're a lobbying group or, and you've got to track lobbying, where you're doing timesheets, and that person's aggressively charging, his reasonable amount of time for what he's spending on that area. If I make $100,000, that's a $10,000 deduction every year when you've got these timesheets that verify this. And on the more complicated areas where you're talking about allocating costs, like for building costs and things like that, again, a standard methodology is the best way. We're fairly conservative because we don't want to have the IRS come back and challenge us successfully. But again, if it's documented and it's done well and it's done consistently, we have the IRS come in and they'll look at it and agree with us. And if there's a little bit of an argument, it's really not that big of a debate when it's all established and it's written out. And so it really is a matter of having first a good cost structure from an accounting standpoint. So I hope that was helpful in the brief amount of time that I had. And if you do have any questions, there's two things. One, at the last slide, I'll put some materials up on this area here. So if you go to look at the slides, you can connect to my site, rafa.com, and just look for Venable. It'll have and it'll have this course on there and some of the materials and some of the other areas. But also my direct dial, you can call me anytime. I'll leave some business cards up front, and I can answer any questions you have about allocations and things. So thank you all very much for coming, and we really appreciate your time.
Thank you, Tom. Thank you, Tom. Thank you to Matt and Lisa as well. Hopefully you guys all here in the room and on the telephone and across the country found this to be a valuable program. A lot of information to digest. Thanks for sticking with us a little bit longer. The recording of this session and all of the slides, including Tom's, will be emailed to all participants tomorrow. They'll also be posted on our website. And we hope to see you on July 12th at our next program here at Venable. Thank you very much. Have a good day.
Yeah, well,
heard you were at Nina.
Yeah, 2 days a week.
Okay.
Just my semi-retirement thing. And I'm having a wonderful time. Great organization.
Do they still work with you? At Galantera? The lawyers. They used to. When I worked at that firm, early in my career, they were the lawyers of the Nina.
Kathy Cleveright, is executive director. Oh, okay.
You guys did? Yeah. He's been with them forever.
Right.
Yeah, you're right. He has. If you want to, in my card here, General Counsel, if he wants to be added like to all of our to look at that he can, continue to get up to speed on some kind of stuff. Yeah, so that would be great. Did you guys find this helpful?
I'm glad you got it.
I'm glad you get to work with Mary. She's terrific. I worked with her for years at Great to meet you. Good to see you, Mary.
Started American Bankers.
I
know Justin Kaufman.
Yep. Yeah, he's a great guy. How do you like it there? That must be an organization going through a lot of transition, right?
Yeah. And in terms of how we treat
Right. So what's your title there?
other than
Perfect. Right. You have your current contact here.
is there anything internally that we need to be treating either out
No, I am not at a chance to go. I don't know if I'm going to be able to get over there. Oh, it's so good to see you, as always. Sure. Yeah, of course, yeah. She and I serve on the ASCE legal journal. There's an editorial advisory committee of the service. Got to know her every day.
I know her about friends and also like American Jewish University.
Oh, really? I didn't know. She's great. It works out like her. Who's the general counsel at ABA now? Oh, yeah. I just ran into, last week, the former longtime general counsel at ABA, a guy named John Gill, kind of a legend around there. 3 days your time. All right, good to see you.
now, would they ask us to help them? We get a percentage of, also a percentage of the ticket price. So how do we treat that? Is it part of this whole? They have advertising. Yes.
Yeah, but because it's a local event, it'd be a lot easier because you're only going to worry about where you go. Because they're probably not going to advertise the event.
What would they advertise? I mean, we got he's researched kind of a magazine.
Okay.
And the magazine, with that, he has a nonprofit as part of his enterprise. So the process of the programs are being split two ways. One to the due diligence, the other one to the national and the third one to his foundation. So that's where the proceeds go. But we contribute because we've agreed to help him sell tickets so that he benefits from those proceeds coming in. Is that happening?
sounds like it's more active. His foundation is C3, so the organization is putting it on also C3.
No, his organization is not even, it's the profit.
So it's a tax organization. So it sounds like it's a bit more than passive, but being a small organization, I think you can make the argument that you're a very minor role. You're doing this to promote hand dancing in society at large. You're not selling the tickets so that you make
Right.
the more people that attend, the more people that participate, the more people that will learn about it.
Right, so we're gonna have a presentation.
Right.
Okay, at that event, I have a booth at the event, and, we will, give out information about what we
I think that it's argumentative, but I think you take position as your first consideration. I think it's first your mission. The only concern I would have with respect to the adventure stuff, this magazine going to get everywhere in the country, and are you required to register? Yes, you. Because by having your name attached to his advertising, some states allow you to engage in participation in their state. Massachusetts, you have a pretty grand mission. So they want to figure out one-time thing. Then
Yeah, he may do it next year, but this, right, he does it annually.
The may fall under the filing requirements, the expense of finding out may not be worth it for you at this time to go through the whole thing, figure it all out. So your first time maybe is necessary succeeding during the law that comes up every year, really look into that. With your participation, if he comes to you every year, next year and the year after, why am I paying so thank you. In that case, we originally the value there. And that's all those yeah, that would help.